Hey, what's up, guys? So we're back today, and I hope you guys had a very good day today. Hope you guys had a very good trading day as well. Hopefully, you bought something, but not necessarily because the stock market is trading at a pretty high number. And if you're in my course, you know that you want to buy at low prices, and then keep when it's high. And there's different indicators that can tell you guys all that stuff. So in this video that I'm making today, um, again, I'm going to choose a stock from a specific ETF, right? Specific sector. And then I'm going to go over the fundamentals. But again, I'm only trying to keep this video for about 10-minute long video. I'm not trying to have it too long, like the 45-minute video last time, just so it can be easily digested by you guys. And then, I'll let you know if this stock is a buy or not. So today I am on XLF. So XLF is the consumer discrete select sector, and not XLF, I'm sorry, XLY. It's the consumer discrete select sector. So it has all the consumer staples. And so what I'm going to do is I'm going to choose a random one, and one that I haven't went through yet. And Yum Brands, I have no idea what that is. I have actually never been through Yum Brands before, so it has interesting names. So I just decided let's go through it. So what I'm going to do now is go to Yahoo Finance, the usual. So we're on Yahoo Finance. And what we're going to do is type in Yum Brands, right, at the search bar. We're going to go through it rather quick today, so you guys can understand, watch the entire video. I'm going to keep it really short. So as you can see, it's trading at 104 and 4 cents. So it's down about 72 cents, 69%, down 21, about 20, what is that, 20% after hours. So let's take a look and see what we can find on the summary. So the X has dividends about 1.79%, so $1.88 per year and per share. Let's take a look. EPS is 3.44, which is pretty good. It's not the best, but it's pretty good. P ratio is 30. So you're buying it about 30 times the EPS. So you're buying it about 30 times what the earnings per share says it's worth. Okay, so which isn't too bad. Most things are around that price point, to be honest. It is a little overvalued because you want to have it at 15, but that's just general what investors say. But it's not too bad from what I'm looking at here. The EPS isn't too bad either. So let's see what we can do. So let's just go straight to it. We're gonna go to analysis. We'll look at some other stuff, but we're gonna go straight to analysis. Oh, I'm sorry, maybe not analysis, financials. I'm sorry. So we're gonna go to financials, and come on, there we go. And we're gonna go to their income statement first. So as you can see, to the revenue again, they're in the thousands, so it's 5 billion to be exact. So take a look. I'm trying to scroll over. So you take a look and you see from 2016 onward. So started at 6 billion. It has been subsequently decreasing. So it's not really positive, honestly, especially from 2016 when they had 6 billion. This has been decreasing. The total trailing months they're starting to go back up in 2020, but still, that's not looking too good. So cost of revenue, it's about, as you guys can see it, that's the cost of the revenue that they have in order to produce what they need to produce and sell what they need to sell or so. So the gross profit, again, it has, well, looks like their gross profit has been staying pretty stagnant. Not too bad. It's okay. It hasn't really been growing per se. It has kind of like 2019, so it grew the most in 2019. So it's not bad. So the gross profit isn't bad. At least they're taking home some profit after their cost of revenue. So about 2 billion. So it's not too bad. So almost three. So yeah, it's not too bad. And let's see what else I look for in here. Um, yeah, pretty much it. I'll look for here. So then the next thing you guys want to do is go to their balance sheet, right? Let's take a look here and see what we can find. So again, their balance sheet. No, actually, no, it's loading. So yeah, actually, again with their balance sheet, their total assets been was decreasing from 2016. So it doesn't like they were doing so hot from around this time. They started picking back up in 2019, so it's not bad. But again, you want to be careful of this right here, this 3-year type of revenue decrease. I mean, asset depreciation. So I don't know what was going on. Um, and that's your total asset. So what you want to do is expand. Let's take a look. So you want to take a look and see their current asset. So it's about 1 billion. Again, subsequently decreased. Oh well, no, I'm sorry. It actually increased. Then it took a dip in 2018, and now it's back up in 2019 around that time. So current asset, not bad, but we got to really know by looking at their current liabilities. Remember, we have to make sure that their current liabilities is smaller than the current asset. Here we go. So the current liabilities is about 1.5 billion, and their current asset is about 1.5. So let's see which one is more. Current liabilities. Where are we at? So right here. So I believe the current liabilities is more. It's 1541, and for 2019, 1527. Yes, yes. So it's more, and it's been like that actually from yeah, so it's been like that from 2018, 2017. So all the years are showing the same, except for 2017. 2017 was a good year for it. But yeah, as you can see from 2018, 2019, the current liabilities have been bigger than their current asset. That means that they're not really making even. So with their current liabilities, that's what they have to pay within a 12-month period, in order to keep their operations going. So they probably have to sell their assets and sell other things in order to make these payments. So they're kind of, I would say, financially struggling. It's not too bad, but again, they've been, they have more liabilities than they do have assets for the past 2 years. So that's not really good. And let's take a look at total non-current liabilities. So where we at? So here's the total liability. So it's 13 billion. And let's take a look. What was the total? Look at total asset, only 5 billion. So yeah, this company has a lot of debt, I would say. So just by looking at that, they don't have any, the retained earnings is negative. So after they pay out their dividends, their retained earning is negative. So they're not really having any money inflow. They're actually losing money. So stockholder equity is negative as well. So that means if you're a shareholder in this company, that like their debt totally outweighs their assets. So because of that, you have like you're not um, you're not earning anything in this company. You're losing value. They have too much debt. The equity in this company is not good. So you're not really uh, having any value with this company if you're a stockholder, if you're a shareholder. So you want to be careful. As you can see, it's been growing in the negative direction. So I wouldn't per se choose this. So actually at all. Um, yeah, as you guys can see, it's not looking too good. Their balance sheets are looking pretty bad. Let's take a look. They probably need to stop paying dividends. Uh, so let's take a look at cash flow. Last but not least, um, as you guys can see, let's expand it. Um, Free cash flow. Here it is. Let me expand your boy. Free cash flow. Um, well, their free cash flow isn't bad. At least that's showing you after they pay off everything. They have about $1 billion that they can kind of allocate to their shareholders. Like if a company was to pay off everything, how much would they have in free cash flow to allocate to their shareholders? So that's been increasing. So it's not too bad. But their balance sheet is not looking too good. And I don't really like that they have so much debt. They're not. this company takes on a lot of debt. And you guys can look here too and see what their revenue's been looking like since 2016. And you can see the revenue has been decreasing. That's what I like about Yahoo Finance. It gives you their earnings and their revenue from the subsequent years. And it has been decreasing, and so has their earnings as well. It's not looking too good. Yeah. So you can even see this right here with what is beat and miss in their quarters. So miss, beat, beat. Yeah, 2020 has been picking up steam. So it's been doing good in 2020. But again, the past years and their balance sheet just not looking too good for me. I mean, it makes sense. They're getting a lot of cheap money in 2020 from the government. So they don't have to, they're getting a lot of things that can help them. So that makes sense. They're doing good in 2020. Let's take a look what else I can look at. And other than that, we're pretty much done here. Is it analysis? I'm sorry. I don't think so. Sometimes I have a problem working it on the laptop. Is it profile? I think it's profile. Come on. Let's see. So let's take a look here. No, it's not profile. I'm trying to, I think it's stats. I'm sorry, guys. I'm trying to take a look at their payout ratio. So this company is overvalued and their balance sheet is not looking good. So I would stay away from it. Payout ratio, not bad, only 53%. So they only whatever earnings they're getting, they're only paying about out in dividends only 53%. So that's not bad. That's actually not bad. Yeah. So still, their retained earnings isn't looking too well. So let's take a look, and let's go back to summary. Promise, guys, we're almost done. So let's go back to summary, and then we're gonna go to their chart, and let's see what it's looking like. All right. Come on. So we're gonna let's do max. Let's see what their max chart's looking like. Is this their max? There we go. Wow. Whoa. Okay. Their max chart's looking pretty good. This is a thing that never makes sense. So this company has too much debt, and their max chart, they're barely beating earnings. They have a decent free cash flow. I mean, payout ratio, is good. But still, they just have too much debt to me, and it's overbought. I mean, it's at 61, so I would stay away from this. It's overbought. It's at 61 in the RSI indicator. You want to take a look at their moving average. They're above their 50-day moving average. I bet you if I did 100, they'll be above it too. So 100. Yeah, above it. So I would stay away, and we can even do Bollinger Bands. Let's take a look. Working at an indicator. Let's see. There we go. Bollinger Bands. Yeah, leave it at that. And yep, they're touching it. So this is pretty. It's gonna go down eventually. I would stay away from it. I just do not like. I just don't like. Let's go to year to date. Let's go my TV. Yeah, I just see. I mean, it touched it right here, 2016, and it's coming back down. I just don't like their debt, man. And they're not really growing in terms of revenue like that. And we took a look at a lot of stuff. I mean, their earnings are going down as well. So yeah, it's this company is it's not doing too well, but it's keeping afloat just through probably being able to take in a lot of loans and stuff, most likely from the government. So I would stay away from it unless it dips really, really low. Just about looking at the fundamentals and technicals, I wouldn't purchase this. It's too high. It's exorbitantly too high. It's 30 times its EPS, and it's not even earning that much. So I mean the EPS is not bad in terms of how many shares it has. So it's earning a decent amount. But we took a look at their liabilities and their current asset, current liabilities. It's not. And let's see how bad it dipped. I mean, and during this whole crisis that we're having. Can I go that back, man? Come on. Let's do 5 years. Be easier. There we go. So it went all the way to $58. Yeah, that makes perfect sense why it went so low. From the highs of what? 119? Yeah. And what's $58? Yeah. Yeah. So yeah, guys, I wouldn't, where are we going? I wouldn't buy this. And so my rating for this stock is not a buy. I wouldn't buy it, not even if it really dipped a lot, because their depth is just too much. Their earnings are okay, and the free cash flow is okay as well. Let's see, that's about it. I mean, let's take one more look at something. Let's go to financials. Expand on. Yeah, I mean, in their cost of revenue, I mean, their gross profit has also been decreasing. Well, it's trying. I'll say it's trying. It's not necessarily terrible. It's just it's overvalued, and I would stay away from it. It looks like the best years are behind it. Honestly, I mean, it was doing the best in 2016, as we all can see, in terms of their revenue and their profit. So I wouldn't buy it. But so in conclusion, to me, this company, this stock, what is this stock called? Yum Brands. It's not a buy. Zilch, zero, not a buy. If you do want to buy, you want to take that risk. Maybe you've done even deeper research through reading what they're doing and stuff. I wouldn't buy yet because it's trading a little bit too high for me. If you do want to get it, let's see where you can get it at. Summary. If you do want to purchase it, let's see where. I would say purchase it at. Are we on the 100-day at 90? Let me see. I'm sorry. Why does it keep going backwards? Well, give me the year to date. So you want to do that. You want to get it at 93.25, like around here. Yeah, so like around 93.84, 90, no, 90, yeah, around 93. So wherever this lavender line is for the 100-day moving average, you want to get around 93. So right now it's at 104, if that's what you want to do, but I wouldn't touch this stock. I mean, and as you can see, the RSI is showing you that it's overbought. It's close to 70. So I wouldn't. It's gonna dip soon. So other than that, thank you guys for watching. I hope you learned something. This is what I do. And for most of my stocks, I mean, the chart is nice. Don't get me wrong. The chart is nice. It got to be producing something. But in terms of their values, it's a little overvalued for me. And I hope you guys learned something in this video. And I'll be back again next week with some more. So, all right, guys, peace out.